Welcome back to Strongman Personal Finance. We're going to talk about a restaurant that is near and dear to my thick, strong heart, and that is Chipotle Mexican Grill. Because I am a fan of Mexican food, I am a fan of Mexicans, but I'm especially a fan of Chipotle Mexican Grill. If you've been watching my channel for the last couple of years, you probably noticed that I do a lot of car videos, and in those videos, I drive to Chipotle. And let me tell you, this business is amazing because it is an AI company, at least according to Joseph Carlson. And do you want to know why it's an AI company? Because they have an assembly line and an avocado slicer. That's right. But that's not what we're going to talk about today. We're going to talk about Chipotle's earnings. We're going to go through the earnings and we're going to look at their financial statements to see what's going on. The stock is up 2.53% after hours. Crazy. So I guess the earnings were good, right? So, Chipotle announces second quarter 2024 results. Before we even do this, let me give you my thoughts on Chipotle. Chipotle is an amazing business because you get healthy, at least it appears to be healthy. You get a ton of healthy food that actually fills you up for a pretty attractive price. So when I go to Chipotle, I get a steak burrito. I get rice, beans, steak, and then I get a couple additional things. And it comes out to $12.09, and I get a water cup. That burrito fills me up for the entire day, and I am a 240-pound man. A Chipotle burrito is the only thing I eat for like a good 10 hours in the morning. And it's freaking amazing. The value of this company, there's no other restaurant or fast food place I go to that fills me up. It's important to me, at least for that reason, okay? So let's go ahead and dive into the numbers. Comparable sales increase 11%. So comparable sales is a metric where they look at a store that's been in operation for at least 13 months, and they see how much sales have grown from that restaurant. Because sometimes there's some stores or some restaurants that can only grow sales by opening more locations. But if the sales at stores that are already open are growing, then they're attracting more and more customers organically without just having to open stores, which is actually a good thing for future profits because you don't have to take all the capital expenditures and purchase or lease a new store. It's a big deal. So comparable sales growing 11%. This company is growing sales at a pretty healthy clip, driven by over 8% transaction growth. So they raised prices, but the prices are still good. And despite only growing transactions 8%, they grew sales by 11%. So the price increases didn't really hamper revenue growth that much, which is good because it's still affordable in my opinion. Total revenue increased 18% year over year, $3 billion of revenue. Operating margin was 19.7%. You would imagine a restaurant, I don't look at a lot of restaurants, but you would imagine a restaurant's operating margin would not be that high. That seems like a pretty high operating margin for a restaurant. I'm just saying. The operating margin has increased from 12.2 or 17.2%. Healthy growth there. Restaurant level operating margin was 28.9%. That's even crazier. So I guess the first operating margin was for the entire company. So the company, I'm sure there's like administrative corporate overhead, and then there's individual restaurants. Obviously. The restaurants themselves are generating an operating margin of 28.9%. So that's their profit before interest and taxes. That's pretty incredible. Assuming or looking at what they have to pay the wages, they have to pay rent, they have to pay, the food, they have to buy the food, and it's actually higher quality food. For all of that, it's pretty impressive that they're able to generate that from a restaurant level. That's pretty crazy, okay? EPS up 32%. And they opened 52 new company-operated restaurants with 46 locations, including a Chipotle. So I don't know what a Chipotle was. It's a drive-through for Chipotle. That would be really nice if I could have that somewhere around me. Okay, I would go even more bananas for this company. But the ones I go to don't have Chipotles. So they did a stock split. It's irrelevant. Remember, a stock split, if you have a stock that's $100 and then you split it into two, you have two stocks that are $50, so nothing has changed. But if you're a total massive clown, then I guess you would believe that was actually bullish for the company. So they kind of talk about what they did, but we can go ahead and look at the financial statements. Before we do that, let's look at the outlook. For 2024, management is anticipating the following. Full year comparable restaurant sales growth in the mid to high single digit range. Pretty good. 285 to 315 new restaurants, with over 80% having a Chipotle. An estimated underlying effective full year tax rate for 25 to 27% before that. So that's interesting how their tax rate's higher. I wonder if they're including state or if there's some kind of, I don't know exactly why their taxes are higher than the corporate tax rate. But overall, everything seems to be going good for this company. And I'm a huge fan, massive fan. I'm addicted to this company. So let's go ahead and look at the financial statements. So they have two primary, and it's awful how they have this set up, but they have two primary sources of revenue. They have food and beverage revenue, and then they have delivery service revenue. I did not know they had a delivery service. The food and beverage revenue is basically all of their revenue. So you go to a Chipotle, you buy the burritos, and they make a profit from that. Food, beverage, and packaging. Only 29% of sales. I believe that's what they're calculating here. Let's see. Let's check that math real quick. Food and beverage costs, this is just for the food, excluding labor, is 2,954,913. 29, okay, so it's roughly that. 29.6% of their food revenue is food, beverage, and packaging. That's nothing. Labor is another big expense. Everything else is kind of minor, except, of course, other operating expenses. And funny enough, for occupancy, for like leasing, I guess, they're only spending 4.7% of their total revenue. That's nothing. Like, this company, they do pretty good. Okay, they do pretty good. Now, if you compare to the prior years, you can see that they cut costs with other operating costs. They cut a little bit from occupancy expense. They cut labor a little bit, which is interesting. And food and beverage and packaging has stayed roughly the same. So they have some cost savings, but they're growing their revenues faster, which is resulting in them growing their earnings per share. Operating income, $586 million. Let's see. Interest and other income. Okay, yeah, they're going to generate a little bit more interest because interest rates have gone up. Really nothing. There's no major red flags. I mean, there's no exploding costs. There's nothing crazy going on here. Let's go ahead and look at the balance sheet. So this is for the 6 months ended June 30th. We can skip that. Let's go ahead and look at the balance sheet. So they have $806 million of cash, almost $100 million of accounts receivable, and they have $683 million in investments. I wonder what investments those are. So their liquid cash position is roughly $900 million compared to, current liabilities. They have over $1 billion in debts, in current debts. But about $182 million is from unearned revenue. That could be like gift cards or something like that. Basically, unearned revenue is money, cash a company has received, but they haven't earned yet. So it's probably gift cards or something like that. And then they have, lease liabilities. But this company has very strong cash flow. They're fine. So we can see their long-term assets. They have $2.2 billion of leasehold improvements, property, plant, equipment. Almost $1 billion of long-term investments, restricted cash and material, operating lease assets. They definitely do a lot of leases. So in accounting, you have to put leases on your balance sheet because it's called a right of use asset. You're using a building. It's an asset, even though you're leasing it. So you have a operating lease asset on your balance sheet, and you have lease liabilities. Basically just showing you how much they're going to be paying in the future. But overall, their balance sheet isn't that crazy. I mean, basically all of their long-term debt is just leases. There's no crazy long-term debt items are about to mature, at least that I can see. So pretty solid balance sheet, but that's not surprising. Let's see what they're doing. So we can see some stock is being bought back, it looks like. Interesting. I wonder if they retired some stock because the treasury stock dropped from 5 million, or something happened with the stock. I'm not sure what happened there, because you can see treasury stock is when you buy back stock. When you repurchase stock and hold it in treasury, you record the cost of that on your balance sheet as a contra equity account, and now it's gone. So I'm not sure. Maybe they retired it. I don't know exactly what they're doing. And if you look at retained earnings, so retained earnings dropped. So I'm assuming they retired. They retired those shares. So, and that affects retained earnings, which is something I learned looking at this stuff. So, next we have the statement of cash flow. So we have a reconciliation from the GAAP or accrual basis of accounting, the profits from that, and we reconcile that. We add non-cash expenses. We subtract non-cash gains or revenues. We add or subtract changes in current liabilities and assets on the balance sheet, depending on what happened, and that helps us arrive at operating cash flow. They had $1.1 billion of operating cash flow. Okay, they're generating more cash flow from operations than their profit. That's pretty freaking crazy. The reason that is because they're adding back depreciation. That's $166 million. They're adding back stock-based compensation. Those are expenses that are recorded on the income statement, but don't represent cash outflows. That's why they're added back. And we can see overall that they're producing pretty healthy cash flow. They obviously spend some money on purchase of investments, purchase of leasehold improvements. That could be just, I don't know, it could be treasuries, or it could be, I'm not sure exactly what their purchase of investments are, but they're definitely spending a lot of money to buy investments. And they spent about $273 million over the past 6 months in property, plant, and equipment. That's a cost of growing the business. They gotta freaking buy more buildings. Let's see, acquisition of treasury stock. Okay. So overall, like very, 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 very strong cash flows. Very, very strong. Like, look at the stores they're opening. They're still opening stores at a pretty healthy clip. And their comparable store sales, they're actually going up. Look at that, 11% increase. It's definitely beating inflation. It's freaking crazy. So, there's really nothing that bad going on. It's a pretty impressive company. I love it. I'm bullish, but don't take that as financial advice because I just love Chipotle. That's literally why I'm bullish. That's basically a little foo-foo reasoning. But overall, very impressive earnings. Fantastic company. If you enjoyed this video, don't forget to hit the like button and subscribe. Don't forget to buy my book, Stop Being a Broke Loser. It's on Amazon. If you want a sponsored video, you send me $50. See the pinned comment below. And if you want one-on-one tutoring from me, I'm a certified public accountant. It's $75. See the pinned comment below. Have a wonderful day. Cheers!